It's December 26th. I'm Reggie Green at Green Home Loans, and here is your mortgage rate and housing update. Interest rates stayed really flat in the week before Christmas, and you're basically seeing the same rates 7 days ago as you are seeing today. So if you're a well-qualified consumer, you can typically get a rate in the sixes, paying a point or 0 points on a conventional loan. And if you are an FHA or a VA consumer, you can typically get a rate in the fives, paying a point, or in the sixes if you want to do 0 points. So these are still some of the best rates we've seen in a long time. And remember, rates were over 8% in October, so we've seen some major improvement. Now, last week we received the PCE inflation report, and we got a really good number. We got year over year PCE inflation at 2.6%. Now, the Fed's target PCE number is 2%. So we're really trending towards that direction, and so much so that the people that analyze these things think that there's an 88% chance that the Fed lowers the federal funds rate in their March 2024 meeting. Now, one topic that's coming up a lot right now with the rate drop is, should I refinance? Should I not refinance? When does it make sense? And I'm going to give you how I would personally look at this. Okay, now if I'm doing a rate and term refinance, this means I'm just trying to lower my rate and lower my payment. What I'm going to look at is I'm going to look at how much money a refinance saves me per month and how much it costs me to do. Okay, so give you an example. I'm able to save $200 per month and it costs me $2,400 to do that refinance. Okay, I take the $2,400, I divide it by 200, it tells me it takes me 12 months to recoup those closing costs and my payment savings. So I'm always looking at those two numbers to see if it makes sense based upon how long I plan on being in the home or how long I plan on being in the loan. Now, most people are expecting interest rates to continue to drop in 2024. So if I'm refinancing right now, what I would do is try to refinance if I can lower my payment, but I don't want to pay a ton of closing costs to do it, because the reality is I'm probably going to refinance again. So if I do a refinance in January and pay like $12,000 to do the loan, and I end up refinancing like 9 months later, a lot of those costs that I paid to do the refinance are gone because I didn't really get to use them on the payment over a period of time. So my suggestion on a rate and term refinance is if you can lower your payment and pay low to minimum to do the loan, then I would really look at doing it. Now, when you're analyzing a refinance, closing costs in particular, you want to take out what's called prepaid interest and escrow impounds out of the cost equation. And the one I'm going to go over is escrow impounds. Okay, when you do a refinance, you have to start your escrow account with a certain amount of taxes and insurance. And then the existing escrow account you have right now is going to be refunded to you after closing. So this isn't a true cost to do the loan, and it kind of ends up being pretty close to a wash. So don't look at that in your cost estimates. Now, if you're looking at a cash out refinance, it's really a completely different equation because you're bringing in cash out as the main benefit. So what I would look at if you're looking at a cash out refinance is, what do you need that cash for, and is it beneficial based upon the numbers that they're giving you? Okay, so if you're paying off a ton of high credit card debt and you're able to lower your monthly expenses a ton, it might be beneficial for you. One thing I would always look at though in a cash out refinance, especially now, is I would look at, does a second mortgage or a HELOC make more sense if you have a really low rate first mortgage? Now keep in mind, mortgage companies make more money by selling you a cash out refinance versus a second or a HELOC. But at the end of the day, you want to work with a mortgage advisor that's more looking out for you and not for them. And a lot of times a second mortgage or a HELOC just makes more sense. Lastly, I want you to keep in mind, when you do a loan through a loan officer and a loan originating company, we have these things called early payoffs or EPOs. And what happens is when we do your loan, after it's completed, it is sold to an investor, and the investor pays a premium to get interest payments over time. And if that loan is paid off typically within 6 months, then the loan officer and the originating company has to pay back any commission. Now, this can be really hurtful to a loan officer, especially if you're super close to that 6-month period. So if you just did a loan and you're looking to refinance, contact your current loaning officer and see if they can just set you up for a refinance on the 6 months. It's really going to help them out a lot. And to be honest with you, rates are probably going to be lower in a couple months anyways. So I'm Reggie Green here at Green Home Loans. Please call a Green Home Loans loan officer if you want to look at any purchase refinance options. We'll be honest with you. We'll tell you if it makes sense or not. Hope you have a great New Year's, and we'll talk to you next week.